In this video, we're going to look at employee share purchase plans. An employee share purchase plans, or an ESPP, often permit all employees to buy shares directly from their company at favorable terms. The primary intent of these plans is to encourage employee ownership of the company's shares. Presumably, loyalty is enhanced among employee shareholders. The employee also benefits because typically these plans allow employees to buy shares from their employer without brokerage fees and possibly at a discount. Some companies even encourage participation by matching or partially matching the employee purchases. The accounting for an ESPP is basically the same as the sale of new shares, assuming three things exist. One, substantially all employees can take part. Two, employees have no longer than 1 month after the price is fixed to decide to participate. And finally, the discount is no greater than 5%, or we can have reasonable justification for it being higher. If these three items are not met, then we must record compensation expense. So for any discount that's greater than that 5% mark, we would then have to record the compensation expense. Okay, so in this problem below, let's look at it and see what would we record. Carlvat Motors disclosure notes for the year ending December 31st, 2015 included the following regarding its .001 par common stock. There again, that's just to prove the par is pointless. It's just required by some law. The employees are eligible to purchase common stock through payroll deductions of up to 15% of their eligible compensation, subject to any plan limitations. The purchase price of the shares on each purchase date is equal to 85% of the lower of the fair market value of our common stock on the first and last trading days of each 6-month offering period. During the years ended December 31st, 2015, 2014, and 2013, 222,471,000, 165,500, and 520,373 shares were issued under the ESPP for $39.4 million, $30.5 million, and $15.7 million respectively. A total of 3,634,749 shares of common stock have been reserved for issuance under the ESPP, and there were 2,134,851 shares available for issuance under the ESPP as of December 31st, 2015. Prepare the journal entry that summarizes employee share purchases for the year ending December 31st, 2015. So how would we record this entry on December 31st of 2015? Well, first and foremost, we're selling out shares of stock. Had the discount been less than 5%, we would simply hit the cash payment, we would credit the common stock at par, and then any extra over par would go into our PISIP on common. Now here's the problem. Since we exceed that 5% threshold, we're at 15% discount because they can purchase it at 85%. We're going to have to also record compensation expense. So we're going to move those two down. Again, had we recorded this for less than that 5%, we would have been okay. We could have just done cash for what the employee paid, our common stock at par, and then the difference in PISIP, just like a normal issuance. Since it exceeds that 5%, we must add into the entry compensation expense. So how would we calculate each of these? Well, the cash is given to us. It says that the shares were issued under ESPP for $39.4 million. Oops, messed up my formula there. In 2015. So that's going to be the amount of cash is $39.4 million. We don't have the exact number. We just have it in millions there. All right. Now, how much would we record for compensation expense? Well, it's going to be the difference between what they would have paid, okay, and what they did pay. So let's go in and see what is that 15% discount amount. So we go in. The easiest way to find that, now we paid 39.4, right? and that represents 85%. So the way we would do it, some price, we're looking for the price, times 85% would have given us 39.4. So how would we solve that? Well, we would take 39.4, divide it by the 85%, and that would give us 46.4. Now, all these are rounded. It doesn't give us that full exact number, but it's very close if we round to 46.4. Now, 46.4 being the total, we would multiply that by the 15% discount, and that would rounded give us $7 million in compensation. In other words, we're giving them that benefit because the discount amount is greater than that 5% allowed. Okay, so our compensation expense would be $7 million. Now, how much would we record our common stock at? Well, since we're recording in millions, it's actually going to be zero. But how would we calculate that? Well, remember, we issued 222,471 shares, and it's at 0.001 par, which gives us $222.47 or something. So it's a very, 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 very small number. So this is not actually zero. It's 222 bucks, which would be what, 0.000222. So we're not going to record that in there. So that's not actually zero. Keep in mind it's $222. Okay. But we're going to show it as zero because we're showing it in millions. So it's a little quirky. All right. Now, how much then would go into our total paid in capital in excess of par? Well, it would be the 39.4 plus the 7 plus the 222. It gives us 46.4, which happens to equal the total amount there for our compensation. Now we're a little bit off because we're rounding so much in these numbers. So I know, let's see what that doesn't quite equal. Yeah, it does. Okay, we're good. So I just wanted to make sure when we round numbers, sometimes it gets a little off on us. But when we have that over 5%, excuse me, we must record the difference as compensation. So that 15% of the total purchase price would be recorded as compensation. If that's not the case, then we would simply hit cash, common stock, and PISA, as long as the discount amount is 5% or less. All right. So hopefully that gives you a little bit of an example of how you would record an employee stock purchase plan if the discount is greater than 5%. If the discount's less than 5%, we wouldn't have this number, and our PISA would simply be the 39.4, which, add those two together, remember it's $222. That would be our entry if our discount was 5% or less, in theory. Since it is not, we have to add in the compensation expense, which is that 15% discount. Again, we've rounded a little bit because the way our numbers come out, but that gives us right there that $7 million in comp. All right, so hopefully that gives you a little bit better understanding of how to record entries for employee share purchase plan.